In 2000, basically in early 1990s, repo already started in India. But the present format of repo is actually known as liquidity adjustment facility. LAF started from 2000, right? Already, actually it was already declared in 1999, but it started from 2000 under the recommendation of Narsimham Committee. Under the recommendation of Narsimham Committee. Okay, it's a very famous committee. All right, in the future also we'll be discussing about this committee multiple times. So Narsimham Committee says that there should be liquidity adjustment facility. Now please remember this. CRR, banks cannot withdraw. If I am a bank, I am SBI, and I want money right now, right? Not for the bank run. Bank run is an extreme form of emergency, but I'm running out of money right now. Just for 2 hours, I need money. Or for 1 day, I need money, right? Because I have 2-3 clients who are coming up for a large loan and my branch does not have a money. I cannot take money from CRR. It is fixed. I cannot break down SLR because there is going to be a penalty on both the things. Then how will I be able to get money? I need money. My branch needs money right now. I cannot trust my customers that tomorrow my customers will come and they will deposit money and then I will use that money to give to the other customer as a loan. I can't do that. So the amount of liquidity, that is the money held by the bank, should be adjusted quickly. And that is liquidity adjustment facility. As I told you, break down the term. The liquidity with the bank should be adjusted quickly within a day up to 3 years. Within a day to 3 years. Now, if SBI is running dry, means SBI does not have money for, let's say, next 7 days. SBI can go to a private bank. SBI can go to a public bank. We have already discussed what these two are. Or SBI can go to, let's say, IPO, but that is a capital, right? That's an investable capital. Or SBI can go to who? The father bank, RBI. Now, previously, SBI had to rely on these other forms, which were high interest rate, cost of capital. The cost of borrowing was very high. Hence, banks were reluctant. Hence, if you go to a bank, let's say 20 years, 30 years back, bank will be reluctant to offer you funds. They will wait for their customers to come and deposit money, and when they have deposit money, enough money, they will call you ki sir, aapka loan pass ho gaya hai. They will release your loan. Otherwise, they were reluctant. Now, if you go and they say ki sir, we will clear your loan in 20 minutes or 50 minutes or half an hour or 2 days or 5 days. How? Because they have LAF. So if SBI needs money, let's say today SBI needs 10 crore rupees, SBI will just call RBI. I need loan. And RBI will offer loan. But is RBI so stupid that it will just provide you loan without any collateral? When you go to buy a house, let's say a property or a flat, what is collateral? Your property papers. When you buy a car on a car loan, what is collateral? Your car, right? In your registration certificate, that is RC of a car, the name of the bank, the lender is written. Please remove that. It's a humble request. If you have a car loan, do that. Remove that. Once you pay all the money or the loan, get it removed. So the point is that RBI wants a collateral. Guarantee chahiye. RBI requests a guarantee. Give me a guarantee. Now, what is the guarantee that SBI can give? That is repo. Let's understand that. SBI, RBI. Let's understand situation before repo. Okay. Now, RBI has given a government security to SBI. Government security means RBI want money. Basically, government want money. Whenever government of India wants money, they give government securities, let's say 9 treasury bills, right? 91 days, 182 days, 364 or 364 days, so on and so forth. They offer treasury bills. Now, government of India offers a T-bill to RBI, let's say for 364 days. Now, it is the duty of RBI to sell this. When RBI sell a government security to SBI, SBI buy that. So RBI is sell GSEC, SBI buys GSEC. Who produced GSEC? Government of India. Now SBI offer the amount of GSEC to how much? Let's say it is 100 crores. Now the 100 crores transfer from SBI to RBI and SBI has GSEC. Now you might think, why SBI is buying government securities? Because there are two reasons, there are multiple reasons, but I'll discuss the two as well. They buy government security. SBI is buying 100 crores of government security for two reasons. Number one, GSEC are most secured. Most secured. I mean, it's a guarantee. It's a guarantee investment. It's the most trusted investment model. Today you invest somewhere and it collapses. You buy a mutual fund, the company collapses. You buy the shares of some company, the company collapses. But here government does not collapse. So it's a most secure investment. So SBI will commit that kind of investment. And secondly, to meet SLR requirement. To meet SLR requirement. That's it. These are the two methods. Most secure and to meet SLR requirement. Remember, 18% they have to keep under SLR, and I told you that the highest percentage that they keep SLR is the government securities. So that's the case. Now this is the normal instance. We are talking about what is repo rate. Repo stands for repurchase agreement. Somebody is repurchasing. Who? This is repurchase. Who is repurchasing? And who is selling? Okay, who sells for the first time? RBI to SBI. First instance, bilkul fresh securities in the market. Okay. Repurchase. Now here the bank SBI will tell the RBI ki bro, please keep these securities, give me some money, I will repurchase this in future. Repurchase. This is first purchase. This is first purchase. This is repurchase. This is second cycle. How will we explain that? SBI sell government securities to RBI and RBI offers, let's say 10 crores to SBI. Some percentage of government securities go there with a promise to repurchase. They make promise of repurchase with each other. That these securities on which the loans are being taken will be repurchased in the future. And it is made by every entity. Clear? Okay. Now the question is, what is repo in this case? What is repo rate? We understand what is repo. Repo is an agreement. Ki I will purchase in future. Right now you keep it, in the future I will get it back. They make this promise to each other. Okay. These are the securities, please give me a loan. So this 10 crore loans goes to SBI and the securities goes to RBI. After the loan duration ends, the reverse will take place. Okay. Then the question is, sir, where is the repo rate, which is determined by Monetary Policy Committee? Where is that? The loan that is offered from RBI to SBI, that is 10 crore at repo rate. And which was, I told you, right? Repo rate, let's say it is 6.5%. as per monetary policy committee. Now the 10 crore that SBI has taken from RBI, where will it go? Where will this 10 crore go? This 10 crore will go to customers. This could be retail customers, you and me, home loan, car loan. This could be corporate customers, right? Industries, firms, entrepreneur, so-called. We have a large amount of culture also in that case. So that's how the things are. That's how the thing works. Now, given this entire cycle, if repo rate is not 6.5% but 7.5%, so SBI is getting expensive loan from RBI, and if SBI is getting expensive loan to RBI from RBI, it will be expensive to the customers also. That is tight monetary policy. So higher repo rate, tight monetary policy, lower will be the inflation. Clear? Now there is reverse repo. So basic understanding is, what is repo? Repo rate is the rate of, or the percentage of interest which is charged on the loans taken by a bank from RBI. It is a percentage of interest charged on the loans taken by a bank from RBI. That is repo rate. Now what is reverse repo? There is reverse repo also, right? Reverse repo is the one when RBI take loan from SBI. Yes, even that happens. RBI just want to keep money out from SBI. That SBI is giving too much of loan. I don't want that to happen. So as RBI will take some loan from SBI. Now RBI is the father bank. So RBI repo rate, reverse repo will be lower. Why would RBI pay more interest? Father bank. He's a commanding force. So usually repo is more. So reverse is just opposite, where RBI take loan from banks. Repo is when banks take loan from RBI. That's how the things are. Now let's understand the bifurcation. What is repo? How the repo is being determined? What are the types of repo? Right? There is LTRO, that is long-term repo operations. There are specific repos. There are targeted repos. Then we have repos for 1 day, 14 days, and up to 3 years. So let's understand this bifurcation. Usually you don't see this kind of bifurcation in the newspaper or any other books, but here we have this for you. So as I told you, why does a bank takes a loan? A bank buys government securities to meet SLR requirements, to use as a collateral, or to have secure funds, because they are the most secure entity in the market. Repurchase agreement. Bank sells securities to RBI and avail loans. Under RBI Act 1934, it is also a statutory provision. Who can avail? Scheduled banks, RRBs, and primary dealers. These are primary dealers, right? We have already discussed what is primary dealer in the previous class. Component, dated bonds, treasury bills, cash management bills, we have already discussed. State development loans, that we have already discussed, right? So these are the 4 entities that a bank can keep with RBI to avail loans. Minimum amount is 5 crore. So you cannot avail, you can say repo for 1 rupee, 15 rupee, or 1000 rupee. During inflation, tight monetary policy, higher repo. That is, higher repo means high loan EMI. And how it is? Normally securities above SLRs are used, right? I mean, why would a bank use the securities under SLR? If they use, the 18% will fall and they have to pay the penalty. So that is repo. Now repo can be fixed repo also, variable repo also. Fixed repos are the one that is monetary policy usually determines. Interest rate is linked to the repo rate. Let's say if it is 6.5%. So this is fixed. It is going to be fixed for 1 to 3 years. It is not going to change. Types LTRO up to 3 years. Targeted LTRO for a specific loans, right? Special LTRO for a small finance bank. Small finance banks can also avail repos. All right. I mean, these are the recent innovations of the RBI. Targeted LTRO is for a specific purpose, for specific loans. Let's say a bank Diwali season is coming. In Diwali season, they have to offer more, let's say car loans. So for car loans, they require more money. So for next 3 months, SBI can avail this targeted LTRO. Then comes reverse repo. When RBI takes loan from the bank, Here also it is fixed and variable. Both repo or reverse repo are fixed and variable. Variable rate means which changes within a day. Today it is 6.5, tomorrow it can be 7.5, day after tomorrow it can be 4.5. It changes every day depending on the competition. Who compete? Banks. Let me explain this to you. In variable repo, let me explain you the fixed repo first. In fixed repo, let's say SBI approaches RBI at 6.5% for 2 years, right? For 2 years they are availing loan. Okay, it's okay. Now for 2 years it is going to be 6.5 only. It is not going to change because this is fixed repo. Now here the things change, right? Here, as when SBI approached RBI, they came across that ICICI, HDFC, Bank of Baroda, they have also approached RBI. So there is a competition. There is a competition now. So RBI says, they ask all these banks, for how long do you want money? They say we want money for 14 days. Okay. For 14 days we have 4 contenders. Now let's start bidding. So there will be auction. And whosoever bids, let's say SBI say I can give you 6.5, ICICI say I can give you 6.25, HDFC say I can give you 7%, Bank of Baroda was the most eager one, says I will give you 7.25%. So Bank of Baroda wins the auction and RBI will give money to the Bank of Baroda. So that is variable repo. Variable repo means when the repo rate is changing 1 day and beyond, overnight, 1 day, 14 days and up to over 14 days. So these are very short period repo. That's why there is a more competition. All right. Please remember, I have written a note over here. LAF window is not available 24/7. RBI opens the window on its website to these banks and then they can apply. So don't think that SBI is RBI is open and it's 24/7 available. SBI can avail anytime. And at 12 midnight, SBI calls the RBI and say ki, I want 10 crore rupees and please send me. That is not the case, guys. So LAF, liquidity adjustment facility, as per the Narasimhan committee, functions in this manner. And in the newspapers also, whenever you open the newspaper, you will read more about repos rather than CRR or SLR because they are more stable rates. CRR and SLR are more stable rates. Repo is very variable from 1 day to 3 years. All right. And they impact the inflation very quickly. Within 14 days, they can increase the rate of interest in the economy. The loans can become so quickly expensive that you can't even imagine, or become cheaper if there is a deflation. All right. So that's all in these, that's all in monetary policy. And the other monetary policy, SLR, CRR, repo rates, and how the monetary policy transition takes place. The coming things, that is bank rate and other interest rates that are being charged by RBI, will be covering in the next class. Thank you.